If you're looking for a stock market weekly wrap in one easy to digest package, well, this is the video for you. We'll talk about everything that's played out over the past week, all of the news and announcements, and get you prepared as we start thinking about the week up ahead. From Elon Musk looking to buy Twitter, to the CPI inflation numbers, and some central banks around the world lifting interest rates. We'll unpack those pieces of news and everything in between. Welcome to the channel, park up with a cup of tea, and we're very grateful for having you join us. Well, I guess first and foremost, it makes sense for us to have that broader overview about how things are currently positioned and where did the week end over the past period. So to kickstart us off, looking at the S&P 500 as a proxy for the global markets, the flagship index was down by a negative 2.1%, but actually the Nasdaq, the proxy for the growthier end of the market, underperformed, down by negative 2.6%. There's obviously some indications with the high inflation print and some discussions about what that could mean for interest rate sensitive ends of the market, along with rising yields, all of which we'll talk about later on in the video. This led to a more risk-off tone to many different sectors of the market, and this is why we saw some of the underperformance from some of these areas. On the ASX front, it was up by 0.6%, led higher by the materials once again. It seems to have been a common theme over this past period. Obviously, the ASX has got a higher weighting to the commodities, to the energy, in comparison to some of the other indices around the world, like the US, who have got a heavier tech weighting. If we have a look at the Fear and Greed Index and the VIX, we know that both of these are used to assess sentiment and the current mood or the pulse of the market at this time. Looking at the Fear and Greed Index first, we can see it's at 42. This is below the 50 reading that we had just last week, so it was sitting around neutral. It's got slightly more fear to it, but I think underlying everything on the markets at the moment is really a mood of uncertainty. We're starting to get some more data prints coming through. It's giving us a bit more of an insight about where things could head, but the range of outcomes is still very broad, and a lot of it is contingent on information and events that still need to play out moving forward. The VIX is above that key 20 level. It's definitely well off the peaks that we saw earlier this year when the correction initially started. We do know that looking further ahead as well, earnings season has kicked off. Some of the big banks over in the US have provided us with some insights, but over the next few weeks, earnings will start coming through thick and fast. It gives us a chance to get some insights about how things are playing out. But I think one of the key components that investors and analysts will be looking for is how have companies been able to pass through the rising price and input pressures? Have they been able to do that successfully without a significant reduction in demand? Or are we going to start to see these inflationary pressures come through and affect margins and ultimately earnings? And so then, as we have been over this past period, we'll start off with a discussion about the situation in Ukraine and Europe. It's been quite stark to realise that this situation has been playing out for officially 50 days now since the war officially begun. I think before we discuss anything, as we always say, and really with the images, the visuals, and everything that's been playing out over this past period, it's becoming only more pertinent. But this is a humanitarian crisis first and foremost. The numbers and the loss of life and just the difficulties that we're seeing on the day-to-day, and it's not only in Ukraine, of course, there are places around the world, but the Ukraine situation is one that's been publicised. We just hope that there's a swift, safe resolution as quickly as possible and as reasonably as possible can be made. We know that over the past few weeks, we've seen Russia's focus starting to shift. Initially, they had circled Kiev with that as their target, as their capital, but they're starting to shift their resources and focus more towards the southern and eastern regions of Ukraine. We know that transition has started to begin, but then also over the past couple of days, there was a major event where the Russian warship, the Moskva, was actually sunk. This was their flagship of the fleet in the Black Sea, and it was going to play a key role in this transition as well. Now, there is conflicting stories about how this has actually occurred. So Russia has stated that there was a fire and then the ship sunk as it was being towed. However, the Ukrainian side of the story is stating that they had shot 2 anti-ship missiles, which is the reason why it has sunk. We know that when we're looking at the broader narrative and everything that's playing out, support still coming in from the West with economic sanctions. Obviously, the discussion surrounding energy is a key one, with different regions and different players having different discussions about that, along with resources as well. They continue to flow through. But I think at the end of the day, as we mentioned, the economic impacts are a distant second to the number of losses and some of those scenes that are coming through. So here's to hoping that we see that resolution coming through as quickly as possible. And then moving on to the inflation discussion. As we know, inflation has been one of those key data prints that economists and analysts have really been looking for over this past period. We're at record highs, and the March U.S CPI print maintained that. We saw an 8.5% print year on year for the headline CPI inflation, 1.2% month on month for March. However, what was interesting, yes, these headline figures were 40-year highs, the highest since 1981. But below the line for the core inflation, We know that this strips out those more volatile components like your energy and like your food. This was at 6.5%, but it only added on 0.3% month on month, which was actually weaker than anticipated. Of course, we know that when you're stripping out some of these components, some of the key drivers for inflation that we saw over the past month, such as your fuel and such as your food, another key driver was shelter as well. But when you strip some of those out with core inflation, then the question that the market's starting to have is, okay, are we potentially reaching peak inflation? Of course, a lot of these shorter term inflationary pressures have come as a result of the Europe situation and some of those sanctions. But the question is, as these start to subside, what does the back half of 2022 look like? Do we start to see a more normalized level? Is the rate of growth and the trajectory of inflation going to subside and start to ease? And will we move towards this new normal? If you are interested in getting more of an understanding about the current state of the macroeconomic picture and how things are evolving, we did a video deep diving into this in much more detail, which we'll leave a link to at the end of this video, so stay tuned for that one. There's quite some fascinating insights as well. We know that it's not only the raising of interest rates, but we know that quantitative tightening or unwinding of the balance sheet is something that more and more central banks are starting to discuss. The U.S. Federal Reserve is, of course, one of them. And Lael Brainard, who has traditionally been seen on the dovish side, she gave some insights about where things may head moving forward. We know the Fed has expanded their balance sheet to around that $9 trillion mark. Potentially, it looks like sooner rather than later, with some upcoming Fed meetings, that we could see that unwinding of the balance sheet commencing. It's looking like potentially at $95 billion per month. And on that front as well, as we know, there's a lot of focus on the US markets and the broader U.S. CPI inflation prints as the largest economy in the world. But other central banks are moving as well. No one wants to be left behind, and inflationary pressures are global. And so we saw the Reserve Bank of New Zealand, they actually shocked with the consensus, the majority thinking it was going to be 25 basis points. Reserve Bank of New Zealand had their highest interest rate hike in nearly 22 years, 50 basis point rise to 1.5%. It did take many by surprise, but this was also echoed similarly by Canada. The Bank of Canada raised their rates by 50 basis points to a 1% overnight rate, and they're actually beginning quantitative tightening effective very, very soon on April the 25th. So it'll be fascinating to see how the RBA follows suit, along with other central banks around the world. Bank of England, of course, have been raising rates, and they had a very high inflation print with a 7 handle in front of it. And we know that this is playing out in nations and regions, both around the globe. And so it wouldn't be a weekly wrap without talking about the ever-mercurial Elon Musk. Of course, we had the news over the past couple of weeks that Elon Musk has been building shares and became Twitter's largest individual shareholder with around about a 10% shareholding. But Elon Musk went one step further over the past few days and he submitted a $43 billion US bid, which he stated is his best and final offer, to take Twitter private. He's already the largest individual shareholder of Twitter. We know that he had the chance to join the board. He rejected that. But now he's launched what is seen as a hostile takeover bid. And we know that a key factor driving a lot of this discussion is around censorship and free speech. And Elon Musk has been speaking a lot about it, tweeting a lot about it. And so it's going to be fascinating to see where things head from here. Now, a lot of people are thinking, okay, this has happened. What does this actually mean? What is the likelihood of this playing out? And I think before we discuss that, what we need to understand is a phrase called the poison pill. So the poison pill is a defensive measure that was actually designed in the 1980s to protect from hostile acquisition. One form of the poison pill is a shareholder rights plan that will allow current shareholders of a company, except for the acquirer, to purchase additional shares at a discount. And of course, as we all understand with the way that corporate structures work, issuing more shares would have a dilutionary effect. The ownership stake for the acquirer would be diluted, and consequently that would make the deal less appealing and more expensive for the person trying to make the acquisition or the entity. And so then moving on to Twitter's poison pill, the board have unanimously accepted enacting a poison pill type approach. It is set for a limited duration, with one set to expire on April the 14th, 2023, so a 12-month period. And their poison pill states that if any person or group acquires at least 15% of Twitter's common stock without the board's approval, then current shareholders will be able to purchase additional shares at a discount. So to get a bit of an insight into the mindset of Twitter's board, they stated with their press release that the rights plan will reduce the likelihood that anyone gains control of Twitter without paying all shareholders an appropriate control premium, or without providing the board sufficient time to make informed judgments and take actions that they believe are in the best interest of shareholders. And so while we're discussing hostile takeover defense, of course, we've talked about poison pill, but it's probably worth being cognizant as well of another term called the white knight. A white knight play is where a friendly individual, entity, or company acquires another company at what is considered a fairer consideration when it's on the verge of being taken over by an unfriendly bidder. Of course, it'll be fascinating to see how this plays out, but you don't have to stretch your imagination too far to believe that there's probably a few big tech firms in Silicon Valley currently on the phone to their lawyers and bankers to see whether it is feasible, particularly we know with the antitrust discussion that has continued on over the past few years. And so then with all of that, what are Elon Musk's options? Obviously, he's hoping in the first instance, he has quite a smooth process. Eventually, after some discussions and negotiations, he's hoping that the Twitter's board and management will unanimously endorse the bid to their shareholders. But even if that doesn't happen, there are still some other options. You can obviously buy on market. Twitter is a publicly listed company. You can continue to accumulate shares. Now, that has the potential to be very expensive depending on how he goes about that. Or he could also look to try and win a sufficient number of shareholder votes to ultimately approve a takeover. It's a fascinating time. There's a lot to play out. Elon Musk keeps everyone on their toes, and he definitely knows how to draw the attention. So we'll be keeping an eye both on the news flow as well as on his Twitter, because that is where a lot of announcements have been coming from recently. And then moving on to the election front. We know that the Australian election campaign is now underway. There have been a couple of stumbles to kickstart the election that I'm sure many of you have seen. But what's probably the biggest, most crucial takeaway is that so far there isn't a clear-cut winner at this stage. Of course, there's plenty of time left for polling. There's plenty of policies to come out, plenty of discussions, and we know that the road into an election campaign, it is a long and arduous one. So we'll continue to watch how that plays out. But definitely on an investor lens, I'm very interested to see what types of policies come out, particularly surrounding the electric vehicle, battery material space, that transition towards decarbonisation, as well as for technology and innovation in Australia as well. It's been an exciting week on markets. Drop in a comment, let us know what you thought about it all. Thank you for joining us. Like, subscribe, turn your bell notifications on, and here's another video discussing the state of the macroeconomic economy that I think you might enjoy after this one. Thanks for joining us. For now, stay well and happy investing.